Welcome to the Pirls Stock Market Commentary video for December 26th, 2016. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 1.28 fell from 1.53 last week, remaining within bullish territory. The total count of securities in bullish or bearish patterns increased 4% to 3,319. The count of bearish stocks increased 15%, while the count of stocks in bullish patterns decreased 3%. The Pirls P&F Market Breadth Summary Chart shows us a market now 7 weeks in bullish territory. Paid subscribers have access to the OpenOffice Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart via email, free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 1 point for the 18th advance in 19 weeks. At a positive 406.2 points, it continues above the November 2014 and March 2015 tops, and continues below all remaining 2 tops above plus 100, as well as continuing above all 6 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. The CCI 20 daily at Monday 12/5 close formed a zero-line reject long entry signal inside the plus or minus 50 range, dropping below positive 100 for an exit at Monday 12/19 open. The result of this trade simulation was a gain of 123.46 points on the Nasdaq Composite Index, or $2.79 per share of QQQ. Now at a positive 62.06, down from a positive 98.6 a week ago, the CCI 20 is outside the plus or minus 50 range for a valid zero-line reject entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 34 weeks ago, while the daily CCI 20 began a Woody's uptrend 5 weeks ago. The CCI 20 weekly has fallen to a positive 185.16 from a positive 199.98 last week. We await the return of the CCI 20 weekly to the plus or minus 50 range for another potential trade. Industry rotation, the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: some tech and banking on top, gold and silver, oil services, retail, and REITs on the bottom. Bullish, semis, and comp tech have entered the top 5. KBW Bank has left the bottom 5 and re-entered the top 5. Disk Drives has left the bottom 5 and entered the top 5. Gold and silver continues to lead the bottom 5. Semis and comp tech continue in the top 5. Brokers has left the bottom 5. Oil has left the top 5. Bearish S&P Retail continues in the bottom 5. REITs has entered the bottom 5. Focus this week from www.zerohedge.com. As mystery of China's multi-billionaire default deepens, a new bond scare emerges. We recommend reading the entire short article, but the following paragraphs are a summary of some key points. Should more such 1 in billions incidents emerge, Chinese bond investors, already freaked out by the recent record plunge in Chinese government bond futures, soaring overnight funding rates, and fears over Fed rate hikes, will rush for the exits, just as China's housing bubble is also popping as reported yesterday, leading to a rerun of the U.S. 2006-2007 dual bursting of the housing credit bubbles, only this time instead of an $8 trillion financial system. The world will have to backstop China, whose banking system at last check had over $30 trillion in liabilities. Incidentally, we wonder if now that China's bond insurers are also under the spotlight, if that means China's very own MBIA/AMBAC moments is imminent, as billions in bond insurance contracts are deemed fake by the insurers who would rather not pay up on what is set to be an avalanche of defaults. There's another Chinese financial practice that's prompting high decibel warnings. So-called entrusted bond holdings are a way for financial institutions to skirt rules on using borrowed money to invest in bonds. How? By getting a third party to buy the bonds and agreeing to purchase them at a later date. What could possibly go wrong? How about the worst rout in China's bond market in a decade? That's left regulators concerned about the prospect of investors failing to make good on such arrangements, estimated to involve at least $144 billion of bonds. Thank you for watching this week's Sand to Pearls Stock Market Commentary video, featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you received everything on your wish list for Christmas, that you enjoyed a peaceful and pleasant holiday weekend, that you are looking forward to a prosperous and productive week, if a slow week, coming up. And as always, wishing you true success as well as a happy new year.